Hey everyone, welcome back to Corporate Decoder, the place where we dig into those boring corporate reports so you don't have to. Today we're looking at Rubberleaf Inc. And let me tell you, their recent filing is like a roller coaster ride through the automotive parts industry. Buckle up because there are twists, turns, and maybe a few unexpected drops. So what's the story? Rubberleaf makes rubber and plastic sealing strips for cars. Think of those strips around your car doors and windows. They're trying to raise money to expand. But this report, it's more than just a simple request for cash. This is actually amendment number 4 to their registration statement. That means they've already had to make changes and adjustments to their plans, which is never a great sign. Rubberleaf is based in Nevada but operates mostly through its subsidiary in China. That alone adds a layer of complexity, as we'll see. The company wants to get listed on the Nasdaq stock exchange, but there's a catch. The CEO, Xing Hua, controls over 80% of the voting power. They're also a smaller reporting company and an emerging growth company, meaning they get to skip some of the usual reporting requirements. This can make it harder to get a clear picture of what's really going on. This is still a preliminary prospectus, meaning it could change, and now plenty of risks to consider before investing. The first red flag is their connection to China. They have to comply with Chinese regulations, which are constantly changing. The Chinese government could step in and mess with their business at any time, and that could make their securities tank. Here's another one. They heavily rely on a related party, Shanghai Shenzhen, for most of their sales. What is related party, you ask? In short, it means that CEO has a connection to that company. In fact, almost all their raw materials come from another related company, Shanghai Haozong. Having all your eggs in one basket is never good. And there's more. A US law called the Holding Foreign Companies Accountable Act, or HFCAA, could lead to their stock being delisted if US regulators can't inspect their auditor in China. This table lays out all the sections in this report, so you can jump to whatever grabs your attention, but for now we will go through it together. Let's briefly jump back to the emerging growth company and smaller reporting company stuff. Basically, it means they have less strict SEC reporting requirements, and this can be concerning because it means they can provide less financial clarity to their potential investors, making it harder to judge whether they are a good investment. Now, let's dive into those financial numbers. This is where things get interesting. For the year 2024, they had about $609 million in revenue, but they lost over $2 million. That loss translates to about 5 cents per share. For 2023, they had higher revenue at about $9.9 million, but still lost money, about $1.3 million. Looking at their balance sheet, stockholders' equity is actually negative. That means they owe more than they own, about $2.5 million in the hole for 2024. Now that's not great. They also list a bunch of general risks like the ongoing effects of COVID-19 and geopolitical tensions, particularly the war in Ukraine. These are the kinds of things every company mentions, but they can definitely have an impact. China's regulations on overseas listings are another big uncertainty. They might need to file with the Chinese government before this offering can even happen. The CEO, Xing Hua, has almost all the voting power. This means investors will have very little say in how the company is run. If the Public Company Accounting Oversight Board, or PCAOB, can't inspect their auditor for 2 years straight, their stock could be kicked off the US market. So where is all the money going? They want to build a factory, expand product lines, buy equipment, and cover general expenses. They don't exactly break down how much will go where, which isn't very reassuring. The underwriters, Prime Number Capital LLC, are getting a cut of the deal, of course. They also get warrants, which let them buy even more shares down the line. Time for the management discussion. The place where the management gets to spin all the bad news into something that sounds good. They're betting on growth in emerging markets. They believe as people start to have more money, they will buy more vehicles in areas like Asia, South America, and Eastern Europe. They signed a deal with Volkswagen, which is big. That's good, even if they don't share the numbers. They are also cooperating with Horizon New Energy Auto. It looks like they will be delivering parts to them starting in August, but they have to go through sampling first. They even touch on cybersecurity regulations in China, and they claim they are not subject to review, which should be good news. They acknowledge that there are several competitors. Their only real claim to fame is that they can do both plastic and rubber components, and even then they mention that one big company called Cooper Standard can do that too. There are some pretty scary risks in this report. PRC regulations may impact their ability to operate profitably in the People's Republic of China, or grow through acquisitions in China, which may result in further compliance costs and may delay or inhibit their ability to complete transactions, which would affect ability to expand their business. Their stock may continue to be volatile. On the organizational side, becoming a public company might strain their resources with all the compliance requirements, there is a substantial doubt about the company's ability to continue as a going concern. They also mentioned they may face some problems with local governments in China, and also that there have been a couple significant lawsuits against them regarding payments. Our current auditor has been inspected by the PCAOB, so the risk of running afoul of SEC rules is fairly low. The CEO, Xingshu Hua, she founded the Chinese subsidiary and has been in charge since. The CFO, Hua Wang, is her son. The rest of the board is recently hired and comes from a relevant background. Our board has adopted a written code of business conduct and ethics, trait code, that applies to our directors, officers, and employees. In terms of salaries, the CEO made around $16,000 each of the last 2 years, and the CFO took in between $8,000 and $25,000 each year, so not much. They do have a stock incentive plan to keep people motivated though. Before the offering, Xingshu Hua, the CEO, owns most of the stock with 88.21% of shares, with Hua Wang, the CFO, owning about 5.8% after the offering. Assuming no funny business, those numbers drop a little bit, but she still controls most shares. They have the ability to issue preferred stock later, which could mess with the power of the common stock, so the value of your investment is not guaranteed to stay consistent. A lot of the existing shares are restricted, but they will eventually be able to be sold, which could flood the market and drop the price. That sounds good, but also has risk. The report shows that this company has some issues with internal controls of financial reporting, and it makes some promises to do better. The company says it needs new international expansion as part of their growth strategies. However, they don't have international markets right now. No, right, that was a lot. So what is the overall take on Rubberleaf? I think their direction is shaky. They have potential with their specialization in the automotive parts market, especially if they can get those emerging market sales going. However, they have a lot of weaknesses, relying on a related party and China, plus their finances are kind of a mess. Their debt is definitely a risk, which comes out in the risks and in their actuals. This will require them to find great leaders to mitigate. It's very volatile, so this is not for the faint of heart investor. So what is the recommendation? You should probably do a ton more research. This is way more risky than your average stable blue chip company. Alright. Thanks for watching. Don't forget to like, comment, and subscribe for more deep dives into the wild world of corporate filings. Until next time.